All right, welcome to Iron Financial. This is the channel where we stress test the market hype. Look, Cisco just dropped what looks like an absolute blockbuster quarter. All the headlines are screaming record revenue. But here at Iron Financial, we don't just read the headlines, we inspect the foundations. So today, we're taking our sledgehammers to Cisco's Q2 earnings report. We're going to find out if this fortress they've built is made to last, or if it's just a house of cards. Time to get to work.
So, this is the whole game right here. This is the central question. On the surface, it looks impenetrable, right? You've got record revenue, you've got explosive earnings, it looks like a skyscraper of profitability. But we're not here to admire the view from the penthouse. We're here to inspect the foundation. So is Cisco actually building the future of AI, or is this all just a beautiful facade hiding some deep, deep structural weaknesses? That's what we're digging into.
And you know, everything, and I mean everything, comes down to this one thing. Cisco's AI gauntlet. You gotta forget the old, legacy networking giant. They're staking their entire future on this one high-stakes pivot. They want to become the bedrock of the entire AI revolution. And let me be clear, the survival of this company and its stock price, it all depends on them winning this war.
Okay, hold on. I've seen the glossy press release. I've read the headlines. Record revenue, explosive growth. Yeah, they want you to think they've built Fort Knox over there. But come on, headlines are for marketers. We're investors, and the real story? It's always buried in the fine print of the financials. So, let's just cut the hype. Does the balance sheet actually back up this victory lap they're taking? I'm betting we're about to find some cracks. Let's see if this fortress is actually made of paper.
That's a fair challenge, so let's do it. Let's build their case for them. We're going to lay out the entire bull argument, brick by brick, exactly as Cisco sees it. And we're starting with the cornerstone, that record-breaking top-line revenue. The bulls, they're not just saying this is a strong company, they're saying it's an accelerating one. So, let's examine the evidence. Okay, here's the first pillar of that bull case. It's this massive number, $15.3 billion in revenue. That's a company record. And look, this isn't just a small beat. It is a powerful statement that demand for their core products is incredibly robust. This is the first thick layer of concrete in their fortress. But a number like that is meaningless without context. So let's put it in context. We're looking at a 10% year-over-year increase. Now, for a behemoth, a giant like Cisco, especially in this economy, getting double-digit top-line growth, that's a massive signal of strength. This isn't just some incremental change, it's a significant expansion. You could think of this as a load-bearing pillar of the bull case, proving that the core business is absolutely firing on all cylinders.
But look, a fortress isn't just about its size, it's about profitability. And this is where the bull case gets almost terrifyingly strong. We're talking 31% growth in GAAP earnings per share. That's their official, by-the-book profit for every share out there. Now here's the crucial point, listen to this. Revenue grew 10%, but profits exploded by 31%. That is what we call incredible operational leverage. It means they're not just selling more stuff, they are making vastly more money on every single thing they sell.
And this chart just brilliantly illustrates that jump. We went from 61 cents a share to 80 cents a share in just 1 year. This is exactly the kind of earnings beat that gets Wall Street fired up. It tells a story of really disciplined financial management, of widening margins. This is the steel reinforcement inside that concrete foundation we talked about. It suggests the whole structure is becoming more profitable, more resilient.
And finally, the bull case points to the future. Product orders, they're up a staggering 18%. Now, this is a critical forward-looking indicator. This isn't revenue they've already booked. This is the pipeline for everything that's coming down the road. It signals that the growth we're seeing right now isn't some kind of fluke, it's actually accelerating. So they're not just reinforcing the fortress, they're laying the foundation for a whole new skyscraper. It's a really powerful case.
A powerful case, I'll give you that. It's a beautiful blueprint, for sure. But you know, even the most impressive fortress has potential weak points. An unreinforced wall, maybe a hidden tunnel. You don't find those things by admiring the towers from a distance. You find them by getting up close, inspecting the foundation, tapping on the walls to see what's hollow. So now, it's my turn. Let's start looking for the cracks.
And what do you know? The first crack, actually, it isn't a crack. It's a chasm. And it's right here in the cash flow statement. While they were over there popping champagne about record revenue, their actual operating cash flow, the lifeblood of any company, was plummeting. It dropped 19%. Just let that sink in for a second. Revenue is up, but cash is way down. This is a massive flashing red flag. How can your fortress be stronger than ever when the actual cash flowing into the treasury is drying up?
Let's just put this into sharp relief, make it really clear. The story they want you to hear is over there on the left, 10% revenue growth. Looks strong, looks solid. But the reality, the number that actually pays the bills, is on the right, a 19% drop in operating cash flow. You've heard the saying, revenue is vanity, profit is sanity, but cash is king. And right now, the king is in serious trouble. This tells me that while their sales are up, their ability to turn those sales into hard currency is getting worse. And that is a serious stress point in this so-called foundation.
Okay, next up, let's look at the different parts of the business. The whole bull case rests so heavily on that huge networking number. And yeah, that did well. That's the main tower of the fortress. But what about the other walls, the other ramparts? Take a look at this chart. Their security business, down 4%. The massive services business, down 1%. And their newer observability segment, completely flat, zero growth. So outside of their main engine room, things are starting to look pretty rusty. You know, a fortress is only as strong as its weakest wall, and right now we're seeing signs of decay in some key strategic areas.
And here's another detail that should bother every single investor, and it's very deep in the balance sheet: inventories. They're up 24%. We're talking nearly $4 billion worth of product just sitting there. So you have to ask yourself the question, is this just smart planning for a huge wave of demand that's coming? Or is this product just piling up in warehouses because nobody's buying it? Either way, you've got $4 billion in cash that's tied up in boxes instead of flowing back into the company. And that is a huge contributor to that ugly cash flow number we just looked at.
Okay, you've definitely pointed out some valid stress points. I'm not going to deny that. The cash flow and the inventory numbers, they absolutely require a closer look. But all of this, the revenue growth, the operational leverage, and yeah, even some of those weaknesses you pointed out, it all brings us to the central battleground, the AI engine room. The bull case argues this is a brand new high-horsepower engine being installed that's going to power the entire structure for the next decade. And the bear case argues it's just a fancy spoiler they've bolted onto an old car. So let's pop the hood and see what's actually under there.
So the company's vision, and this is coming straight from the CEO, it is crystal clear. Chuck Robbins says Cisco is uniquely positioned to power the AI era. Now, they aren't trying to build the large language models themselves. They're trying to build the roads, the bridges, the power grids, and the security gates that the entire AI industry is going to be built on. It's the classic picks and shovels play in a gold rush. And with their global scale and decades of trust, they believe they're the only ones who can do it reliably and securely.
And look, this isn't just talk. This isn't just some vision. Here is the hard proof. $2.1 billion. That is the value of AI infrastructure orders they booked in a single quarter from the hyperscalers. And yeah, we're talking about the giants, the Amazons, the Microsofts, the Googles of the world. This number right here is the engine of the bull thesis. It's not a forecast. It's a tangible multi-billion-dollar order book that proves the biggest players in the AI arms race are turning to Cisco to build out their arsenals.
And they're not just sitting back and waiting for the phone to ring. No, they're on the offensive. They are aggressively buying the technology they need. Just this quarter, they snapped up 2 AI companies, Neural Fabric and EaseDubs. The strategy is crystal clear: build and buy. They are methodically, piece by piece, assembling everything they need to become the indispensable, non-negotiable partner for any company that's serious about deploying AI.
Okay, that's a good offense, I get it. But let's be real for a second. $2 billion? That's a drop in the ocean compared to the tens of billions that a company like NVIDIA is booking. Cisco is a legacy company trying to crash the Super Bowl of technology. They're going up against companies like NVIDIA and Arista that were literally born for this moment. So the question is, can a company that made its name on office routers truly rewire its entire corporate DNA to compete with the actual architects of the AI future? That's the multi-trillion-dollar question, isn't it?
And that very question brings us to management's own forecast for the future. You know, their guidance is the clearest signal we have of their own confidence in answering that question. So let's take a look at their projections and how they're deploying their capital. This is really where a company puts its money where its mouth is. And their guidance, frankly, looks like it's been reinforced with steel. For the next quarter, they're guiding for even higher revenue, up to $15.6 billion. And for the full fiscal year, they're projecting over $61 billion. Now, the CFO explicitly said this puts them on track for their strongest revenue year yet. This is not the language of a company that's worried about the competition. This is the language of a company that sees a clear path to continued, record-breaking growth, all fueled by that AI engine.
Confident? I wouldn't call it confident. I'd call it reckless. Let's just connect the dots here, people. They returned $3 billion to shareholders this quarter through buybacks and dividends. Fine. But we just established that they only generated $1.8 billion in cash from their operations. So let me get this straight.
They had a net cash outflow of $1.2 billion just to prop up their stock? To me, that doesn't sound like confidence. That sounds like financial engineering. They are literally draining the treasury to keep shareholders happy while their core operations are bleeding cash. That is not a sustainable model, period.
Okay, that is a very sharp point, and it brings us right to the final verdict. We've laid out the bull case, the strong steel-reinforced headline numbers, and we've stress-tested the whole structure, and we revealed some pretty significant cracks in the foundation. So now it's time for the synthesis. We have to weigh all the evidence. Is this an ironclad investment, or is it a structure with hidden and potentially fatal faults?
Okay, let's put it all on one slide, side by side. The fortress, the bull case. You've got record revenue, massive EPS growth, those accelerating product orders, and of course, that game-changing $2.1 billion in AI orders. I mean, that's hard evidence of a successful pivot in motion. But you can't build a fortress on IOUs. The fault lines, the bear case, a 19% drop in operating cash flow is not a crack, it's a massive fault line running right through the middle of the company. You add to that the stagnation in their other business segments and that 24% surge in inventories, well, the picture gets a lot murkier. The foundation looks really shaky, even if the penthouse is shiny and new.
And all of that brings us to our final synthesized conclusion. Look, Cisco is a powerful, profitable behemoth that is right in the middle of a massive, critical transition. The bull case and the bear case, they're actually two sides of the exact same coin. That's exactly right. The company is spending heavily, it's re-engineering itself to go chase this huge AI prize, and that is causing tremendous stress on its operational core, on the cash flow, on the inventory, on those non-core segments. Their ambitious AI future is basically cannibalizing their present-day cash stability. So the ultimate investment thesis, what it all comes down to, hangs on this single pivotal question. Is their AI ambition, which is evidenced by those massive orders, is it strong enough to power through these operational weaknesses and completely rebuild the core on a new, more profitable foundation? And the answer to that question determines whether you're buying a ticket on a rocket ship or if you're buying a legacy company that's just burning through cash to fund one last desperate bet. The potential reward is immense, no doubt, but the cracks in the foundation are real and they absolutely cannot be ignored. The structure is standing for now, but the real stress test, it's only just beginning.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.